A recent announcement by former President Trump proposed capping all U.S. credit card interest rates at 10% for 1 year. The idea immediately sent shockwaves through Wall Street. Major banks, investors, and analysts were caught off guard, and the stocks of large lenders reacted negatively. What made the situation more confusing was the lack of detail. There was no clear explanation of how such a cap would be implemented, under what authority it would operate, or whether it would even be legally enforceable. As it stands, there is no mechanism that allows a president to unilaterally impose a nationwide interest rate cap on private credit card contracts. Any binding limit would almost certainly require congressional legislation, something that has been proposed before and has repeatedly failed to pass. This legal ambiguity has placed banks in an awkward position. There is currently no obligation for them to comply with the proposal. Behind the scenes, financial institutions have been trying to interpret whether this was a serious policy signal or simply political messaging. Some within the administration have floated the idea of voluntary compliance, such as banks offering special interest cards capped at 10% rather than being forced by law. But without formal rules, most banks are treating the proposal as rhetoric rather than regulation. From the perspective of the banking industry, the reaction has been overwhelmingly negative. Executives argue that a strict 10% cap would fundamentally break the credit card business model. Credit cards are unsecured loans, meaning there is no collateral if a borrower defaults. High interest rates are how lenders price that risk. With average credit card rates already above 20%, banks claim that cutting rates in half would force them to sharply reduce lending, especially to customers with weaker credit profiles. According to industry estimates, the majority of borrowers with average or below average credit scores could lose access to credit cards entirely. Banks also warn that rewards programs, cashback offers, and travel points would likely be scaled back or eliminated to compensate for lost interest income. Industry leaders frame the issue as one of unintended consequences. Their argument is that while the cap may sound consumer-friendly, it could actually hurt the very people it is meant to protect. If lenders stop issuing cards to higher-risk consumers, those borrowers may be pushed,